Well, good afternoon, everybody. Welcome to Sharpen Your Edge, Learn to Trade Fearlessly. This is session 21, and we're going to be looking at volume price analysis, chapter 11. This is next to the last chapter. I know I'd mentioned this morning that this was the last chapter. We're actually going to do one more chapter on here. I think it is a good chapter, shouldn't be avoided, but we'll do the next chapter last, chapter 12. So this is called putting it all together. The market does not run on chance or luck. Like a battlefield, it runs on probabilities and odds. That was done by David Dreamman. And David Dreamman, who is still alive today, said this today, and that is absolutely how the markets go. We work in probabilities and in odds. We don't work in absolutes. But we don't just, it's not just luck. Sometimes it feels like it's luck, and sometimes it feels like we're just guessing on trades, but that's not true. We work in pure probability. Okay, so I'm going to introduce some further analytical techniques, which, when combined with the basics of volume price analysis, will help to develop your trading skills with volume as the foundation. And the first technique is price pattern recognition. And then we covered this when we considered the importance of price congestion. However, the author wants to revisit it here and look at some actual market examples. At the same time, the author would also like to include other key patterns that play an important role in breakouts and reversals, all of which ties into volume price analysis. And a lot of this is right up our alley when we talk about breakouts and reversals. And you may have noticed this morning when we were trading, we were getting into reversals much sooner than we normally do, which I believe is one of the keys, is getting into trades when they turn, especially early on in the early minutes of the session. So the reason for revisiting price recognition is that in the previous chapters, the author was very conscious of keeping the focus on the volume-price relationship and less so on the broader price behavior on the chart. The author's rationale throughout the book has been to explain VPA in stages, and this is another layer we can now add to our knowledge of VPA. The market chart examples in this chapter will focus entirely on market congestion and subsequent reversals and breakouts, which I hope will cement this piece of price behavior firmly in your mind. The first is a lovely example from the Forex market, and it is from the 15-minute chart for cable, which is this. So this chart really explains all we need to know about price congestion and how it relates to the volume breakout when it arrives. As we can see, the chart covers an extensive period with over 70 candles in this phase. If we start at the left of the chart, the initial entry into the congestion phase is marked by a pivot low, which gives us the floor of our price congestion. And 2 bars later, a pivot high is posted with above average volume. The GPB/USD is weak and not only ready to move higher with the pair, then falling on declining volume. So weakness, but not a trend that will be sustained. And the reason should be pretty much obvious. Falling volume, falling prices, and falling volumes. Volumes then decline in general moving between buying and selling, and the market moves sideways in the congestion phase. We can see 2 further pivot points posted, followed by a pivot low. These are followed by a whole series of pivots, both at the ceiling and at the floor of the congestion. And as the author explained earlier when we were examining this concept, you do have to think of these levels as rubber bands, but not as rods of steel. We can see in this example the pivot points. The up and down arrows are not all in a straight line. The market is not linear, and technical analysis is an art, not a science, which is why volume software that attempts to predict changes in trends can be unreliable and totally unpredictable. This analysis has to be done manually, has to be done by us, by people. At this stage, as the price continues to trade within the congestion, we're waiting for the catalyst, which will be the signal for any breakout. And on this occasion was provided by an item of economic data in the UK. From memory, the author believes it was an RPI release, whatever that is. However, the actual release, it's unimportant. What is important is the reaction on the price chart. The price and volume relationship in the congestion phase once again reinforces the basic concepts of VPA. Here we expect to see low volumes. The insiders are not participating, and coupled with narrow spread price action simply reinforces this fact. This is the classic relationship ahead of news. Everyone is waiting on the sidelines and sitting on their hands. This is, if you remember from this morning, we had several reports coming out at 9:45, and we did have some high volume, but not real great price movement as we waited for those reports to come out. And so, to the release itself. First, we have a breakout which moves firmly through our ceiling of resistance, which has now become support. And if you remember what I said in the chapters on breakouts, we must wait for a clear close well above congestion phase. Let's wait for a clear close well above the congestion phase. And the first candle here has delivered this for us. A nice widespread candle. Second, we have to check this as a valid move. And the good news is the breakout has been validated by volume. As we can see, let me get my drawing tools out. As we can see over here, here's the breakout, and here's the corresponding volume that follows the breakout. As this has been an extensive area of price congestion, any breakaway will require substantial effort, which is what we have here with buyers and the insiders taking the market firmly higher. Can we join the move here? This is what we've been waiting for. We have a market that has been in congestion, waiting and gathering itself when finally the catalyst arrives and the market moves on higher volume. So the point is that we go through congestion phases, and then we pick up volume on a move, on a breakout move. We see this every morning. We trade on this every morning. Furthermore, now we have a deep area of natural price protection in place below, and our stop loss would be below the level of the last pivot low. Time has also played its part here and cause and effect coming into play. Remember, this is a 15-minute chart, so an extended phase of consolidation and congestion, and therefore any consequent effect, should reflect the time taken in building the cause. In other words, the trend, when it breaks, should last for some time. We just have to be patient and wait. How many times have we said that? We just need to be patient and wait for the breakout to come. Finally, there's one further aspect to the breakout, which again, the author mentioned in an earlier chapter, and it is this. The volume has validated the news. The market makers have confirmed the data is good news for the UK pound, and the markets have responded. Volume picks up once again as the market moves higher and away from the congestion phase. And to return to the author's salmon analogy, another trend has been spawned. And it doesn't matter if we're looking at UK charts. The author's from the UK, so that's why we get a lot of UK charts and stuff related to the UK. But this is exactly the same in the American markets. We get news that comes out, we get higher volume, we get breakouts. This is the power of the congestion phase. It is the spawning ground of trends and reversals. In this case, the ceiling was breached, but it could equally have been the floor. The direction is actually irrelevant. All we wait for is confirmation of the breakout, validated with volume, and then trade accordingly. I mean, this example couldn't be more simple, I think. We have congestion followed by a breakout, confirmed by volume. Okay. All right, now I'd like to revisit a very important concept. The author touched on this earlier in the book. Again, it's not unique and can be applied to any market and any instrument, and as always, any time frame. Neither is it unique to VPA. What this concept does do is give you that three-dimensional view of price behavior as opposed to the mere conventional one-dimensional approach most traders take. The principal advantage to this concept is to allow us to assess and quantify the risk on a trade. This concept involves using multiple time frames. This concept involves using multiple time frames to analyze price and volume. It allows us to qualify and quantify the risk of any trade and assess the relative strength or weakness of any trade, and so its likely duration. In other words, multiple time frames will reveal the dominant trend and primary bias of the instrument under consideration. This is why we use a 1 minute regular chart, a 1 minute Heikenasi chart, a 5 minute chart, and a 15 and even a 30-minute chart, if you have 3 screens and you have the real estate to see them. So this figure represents our 3 time frames. Despite its size, we can see both price and volume. What we have in this figure are 3 charts for cable, again, GBP/USD. The chart at the top of this image is the 30 minute, and it's what the author often refers to as her benchmark chart. In this trio, it is this chart which gives us our bias and is the one against which we relate the other two. Bottom right is a 15-minute chart, and the chart on the bottom left is a 5-minute. All the charts are taken from one of her favorite platforms for spot forex, namely MT5. Again, it doesn't matter what the instrument is. The candle the author has highlighted on the 30-minute chart is the shooting star. You can see that up here. It's the shooting star. The candle that I just highlighted on the 30-minute chart is the shooting star with ultra high volume, sending a clear signal of weakness at this level. The shooting star was preceded by a narrow spread candle, also with ultra high volume, but which gives us our initial signal. But how does this appear on our faster time frames? Well, on the 15-minute chart, the shooting star is 2 candles, and on our 5-minute chart, it's 6 candles. And you can see the charts have been annotated with a box on each to show you the associated price action. Now, the reason the author uses 3 charts is very simple. Her primary trading chart is the middle time frame of the 3. In this example, it is the 15-minute chart. But using the MT5 chart settings, we might equally have a 30-minute, 60-minute, 240-minute chart, or indeed any of those available. In this trio, our primary trading chart would be a 60-minute. However, in this example, we're using a 5, 15, and 30-minute combination. So the primary of our trading chart is our 15-minute. The 30-minute chart is there as our slower time frame, our dominant or benchmark time frame, which tells us where we are in the slower time frame trend. Imagine if we were looking at price action using a telescope. This is where we are viewing from some way off, so we can see all the price action of the last few days. When using our telescope, we start to zoom in first onto the 15-minute chart, and then in fine detail to the 5-minute chart. By using the 15-minute chart, we are seeing both sides of the price action, the center lane of our highway or motorway. A slower time frame helps in gaining a perspective on where we are in the longer-term journey, and a faster time frame on the other side will give us the fine detailed view of the related price action. So what do we see here? First, the shooting star sent a clear signal of weakness, and on the 15-minute chart, this is reflected in 2 candles with high volume on the up candle, which is also topped with a deep wick to the upper body. And here the point is this. If we had seen this price action in isolation on the 15-minute chart, it may not have been immediately obvious what we were looking at here. It takes a mental leap to lay one candle over another and imagine what the result may be. The 30-minute chart does this for us. And in addition, and perhaps more importantly, if we had a position in the market, the 30-minute chart is instantly more recognizable as possible weakness than the 15-minute. So 2 benefits in one. If putting 2 candles together to create one is difficult, putting 3 candles together is almost impossible. And yet this is the same price action represented on the 5-minute chart. The market then moves into consolidation, which again is much easier to see on the slower time frame chart than the faster one. And the author has deliberately left the pivot points off these charts so the charts remain as clear as possible. The next point is this. In displaying a slower time frame above, this also gives us a perspective on the dominant trend. If the dominant trend is bullish on the 30-minute chart and we decide to take a position on our 15-minute chart, which is bullish, then the risk on the trade is lower since we are trading with the dominant trend. We are trading with the flow and not against the flow, swimming with the tide and not against it. Remember, the trend is your friend. If we take a position against the dominant trend in our slower time frame, we are counter trend trading, and two conditions then apply. First, the risk on the trade is higher since we are trading against the dominant trend of our lower time frame. And second, we are unlikely to be holding the position long since the dominant trend is in the opposite direction. So, in other words, what we're trading here is a pullback or a reversal. There's nothing wrong with this, as everything in trading is relative. After all, a reversal on a daily chart might last several days. It's all relative to the time frame. Now, the third reason for using multiple charts is this also gives us a perspective on changes in trends as they ripple through the market, this time in the opposite direction. The analogy the author uses here is of the ripples in a pond. When you throw a pebble into the center of a small pond, as the pebble hits the water, the ripples move out and away before they eventually reach the edge of the pond. This is what happens with market price action. Any potential change in trend will be signaled on our fast time frame chart. This is where we will see sudden changes in price and volume appear first. If this is a true change, the effect will then appear on the primary chart, which in this case is the 15-minute chart, before the change ultimately ripples through to our 30-minute chart, at which point this change is now being signaled on the dominant chart. This is how to trade, as we constantly scan from slower to faster and back again, checking and looking for clues and confirming signals between the three time frames. With VPA sitting at the center of our analysis, even if you ultimately decide VPA is not for you, trading using multiple time frames is a powerful approach which will give you a three-dimensional view of the market. You can have more than three, but for the author, three is sufficient, and I agree. I hope this will work for you as well. Finally, to end this chapter, I'd like to include a short section on the candle patterns I have found work consistently. And you will not be surprised to learn all these patterns work particularly well with price support and resistance, as well as price congestion. By watching for these candle patterns wherever the market is in a consolidation phase and preparing for a move, coupled with VPA and multiple time frame analysis, this will add a further dimension to your trading. And the patterns I'd like to consider here are the falling triangle and the rising triangle pennants, and finally triple tops and bottoms. But we haven't talked about triangles in a while. There we go. Let's start with the falling triangle as shown in this figure. As the name suggests, a falling triangle pattern is a sign of weakness. We can see immediately from the volume we are in a congestion phase, but in this case, the market is also moving lower. Each attempt to rally is seen as a series of lower highs and is a clear signal of weakness. If this market is going to break anywhere, there is a strong chance it will be to the downside, since each attempt to rally is becoming weaker and weaker in terms of the high of the candles. The floor of the congestion area is very well defined, and any sustained break below here will be signaled with volume. As with all price patterns, the falling triangle appears in all time frames on all charts, and we must always remember Wyckoff's rule of cause and effect, right? The more we get the larger the candle. For a true move, we need a large volume justifies price movement. That's what I'm trying to say. If the cause is large, then the effect will be equally large. In this case, we are looking at a 5-minute chart, but this type of congestion will often appear on daily and weekly charts and is immensely powerful in generating new trends or reversals in trend on the breakout. Haven't marked a triangle in a long time, but they are, equally important, and they are, just as the author said, All right, in this figure from the daily chart of the Euro USD, as we can see, the rising triangle is a bullish pattern. In this example, the market is moving higher and testing the same ceiling level with the low of each candle slowly rising, signaling a market that is bullish. After all, if the market were bearish, we would see the lows on each candle falling. Instead, the lows are rising, suggesting positive sentiment in the market as we approach the ceiling or resistance. We are prepared for the subsequent breakout, which is confirmed with volume. Once clear of resistance, the ceiling becomes support and gives us a natural price barrier for positioning stop losses as we take a trade. The third pattern in this series is the pennant, so called as it resembles a pennant flag on a mask. Let's get to that. There we go. Here in this figure is an example of a candle pattern on a much longer time frame, and is from the monthly chart for Microsoft and shows an extremely long congestion phase. But look at the contraction in the price action just prior to the final breakout, which is here before we break out. The pennant pattern is so called as it resembles a flag on a flagpole. In fact, we put a flagpole there. There would be our flagpole. The pattern is created by a series of lower highs above as the market tries to rally, coupled with higher lows below. As we can see on the Microsoft chart, here we have a stock which is struggling to break higher, yet is not prepared to fall. It is this tension in the price action which creates this unique pattern. Again, as with all formations, the law of cause and effect applies. And in the case of the pennant, the longer tension continues, the more the price action creates what the author calls a coiled spring. It's like as we get lower and lower price action here, as it squeezes what appears to be squeezing price action with lower highs, higher lows, we get to a point where it will spring and break open. And we've done this before. We've marked this on charts before. In other words, the energy stored and built up in the price action is suddenly released in an explosive breakout. The problem is that with this kind of pattern, unlike the previous two, there's generally no clue as to which way the price is likely to break. Nevertheless, it is a great pattern for trading directionless strategies with options. But for trend trading, we simply have to be patient and wait for the breakout, which we generally do anyway. The last two patterns in this set are reversal signals, and the ones I'm always looking for, or the ones the author is always looking for. The market has risen or fallen. Let's get over to that. Okay. In this example of a classic triple top pattern from the daily chart of AUD USD, where we can see the pair has tested the 1.06 level on 3 separate occasions. This region has been tested several times over the last few years, but in the last year it's been tested 3 times, failing on each occasion. And here there are 2 opportunities. First, a position to the short side should our VPA and multiple timeframes analysis confirm this view. Second, if the market breaks above this region, then we will build an extremely strong platform of support if this ceiling is eventually breached. The opposite of a triple top is a triple bottom. And just remember, again, this works in all time frames, but I wouldn't translate it into a 1-minute time frame. The lowest time frame I would use on all VPA is a 5-minute. I think a 5, 10, and 15, or a 5, 15, and 30 work best with VPA. In the triple bottom pattern, the market is testing support and each time bouncing off. Our example of a triple bottom is taken from the hourly chart of the Euro Swiss currency pair, where we can see a classic formation of this pattern. Not familiar with all the currency pairs, I had to translate that. As with the triple top, there are 2 trading scenarios. The first is a long position validated by VPA, or wait for a break and hold below the support region for a short trade. Any follow through to the short side would then provide strong resistance overhead. The good news is We see all these patterns in every instrument and market, in bonds, commodities, equities, currency, ETFs, in all time frames, and all types of trades. These patterns all have one thing in common. They are creating trading opportunities for us by signaling two things. First, an area where the market is in congestion, and second, a market that is either building a ceiling of price resistance or a floor of price support. From there will come the inevitable breakout, signaling a trend reversal or a continuation of trend. And from there, all we need to do is to validate the move using VPA. And of course, VPA, which will highlight these areas for us visually on our charts. When we say VPA, what we're looking for volume and price, right? Volume price analysis. That's what VPA is. So in the final chapter of this book, the author would like to expand on some of the latest developments in volume based on trading techniques. After all, the approach and basic concepts have changed little in the last 100 years. So perhaps it's time for some new developments. And that's it for chapter 11.
Hey, Tim, this is Keith. One of the things that you point out quite often is when we get to a zone, typically it doesn't cross that zone the first time, not even the second time. In this case, it didn't even cross the third time, but a lot of times we see it eventually cross. So definitely on the first one, when we approach a zone, it's likely not going to cross.
Yeah, very true. And we used to talk about that a lot. I haven't mentioned that in a while, in terms of when we get a zone, and our zones that we do are simply support and resistance. That's all they are: a floor and a ceiling of price support and resistance. But most of the time, it takes 2 to 3 attempts to cross that zone before it breaks through, once we've established a zone. So, any questions, guys? Thank you for that, Keith.
Yep.
Hey, Tim, I have a question.
Yeah.
So if you have a 5 minute, 1 minute, 15 minute, and they're not all the same, which one takes precedence over the other? Do you use the 5 minute? Do you use a fit? Which one do you really go by?
Well, you start at the longest time frame and you work your way in, but your benchmark becomes the middle of the two.
Okay, so that'd probably be the 5 minute there.
It would be, in this case, we've got a 30, a 15, and a 5, so it'd be the 15.
Okay.
Yeah, it's the middle time frame.
Okay, thank you.
Yeah, but to clarify that, Derek, generally speaking, once it sort of looks like it's going to look good on the 15, then we go back to the Heiken-Hasse in the 5 minute and look for confirmation. And obviously, just given the time frame, the 1 minute Heiken-Hasse is going to appear of a breakout before anything else does. So I tend to use that one still as the entry and exit. That is, Keith tends to use that one as the entry and exit, and but still watching the 15 and the 5 minute.
Yeah.
Okay. Right now I'm showing the 5 minute is in a put option, and the 1 minute's in a call, and the 15 minute is in a call. So I'm trying to figure out, so you just go by the 1 minute Heiken-Hasse, and that basically then it leads you to the other ones.
Yeah, and a lot of times, like if you see something on the 15 minute that looks like it's a good place to get in, but we're very high in the range on the 1 minute and the 5 minute, obviously you need to wait for that to recycle and then enter it in. And you hear us talk about that quite often, that we're looking for the Heiken-Hasse chart to reset and the MACD on there to reset before we get into that direction trade. So anyway, so clearly the 15 minute tells us the direction we'd like to get in on, but we're gonna still wait for that to reset on the 1 minute, or the 1 minute Heiken-Hasse and the 5 minute.
Okay, very good. Thank you.
Yeah, exactly. Okay. All right, I'm going to stop the recording.